What's up everybody, Gen X Dividend Investor here. In this video I share 7 cheap Dividend Aristocrats which were at least 10% under their intrinsic value and which includes multiple I own. I'll also show you a few Aristocrats that are way overpriced. But before I get to that, I wanted to thank you all for watching and commenting and liking and sharing my videos because you've all helped me get to 75,000 subscribers. Growing a YouTube channel is kind of like dividend investing in that you just gotta keep plugging away at it, and if you don't give up then you should keep growing. And just like there are people with portfolios a lot larger than yours, there are also going to be channels that grow a lot faster than yours. But instead of getting annoyed that your results aren't as good as someone else's, you instead should focus on comparing yourself today to yourself from yesterday. And if you're on a better path, then that's all that really should matter. So either use larger channels or portfolios as motivation to keep growing, or figure out how not to think about them and just focus on yourself. I mean, when you go to the gym, do you get annoyed that someone is benching more than you? Or can you try to learn from them and then just focus on your own results? Because at the end of the day, it's immaterial how other people do. Okay, I'll jump off my soapbox and let's start reviewing cheap Dividend Aristocrats. Feel free to use the timestamp on screen if you want to jump to the first cheap stock, but I recommend you don't skip ahead. Now, the fastest and easiest way to identify cheap Aristocrats is by using my favorite tool, FASTgraphs, which I'm an affiliate of. One of the features in FASTgraphs that I value are their preset screens, which I get access to as a premium subscriber. Their screening tool lets you search through tickers to find things you want, like show me all the stocks that have dividends with a yield over 5%, or show me all the tickers in the materials sector that have a good EPS growth, or whatever. They use their screening tool to create some pre-built portfolios of tickers that are quite useful. Like they have one which shows you all the dividend challengers, i.e. which tickers that have increased their dividend between 5 to 9 consecutive years, and they have one for dividend champions, which are like aristocrats in the sense that they need to have increased their dividend for at least 25 consecutive years, but they don't have the aristocrat requirements of having to be on the SP 500 or having a float-adjusted market cap of at least $3 billion, etc. They also have screens for fair-priced Dow stocks, good growth stocks, REITs with FFO returns over 5%, and a variety of other ones. I'll select their Dividend Aristocrat pre-screen portfolio, and we see that it starts with AbbVie, which is their first aristocrat alphabetically speaking, and is one I'm long in. If you click the drop-down list, you can see all the Dividend Aristocrat tickers. Now, AbbVie isn't a cheap aristocrat, but let's quickly go over some key points about it. And note, I tend to like to teach rather than just show, which is why I sometimes walk you through the steps I'm doing. On this default graph, we see that AbbVie's black stock price line is about at its orange line, as well as a bit above its blue line, which means it's probably fairly valued or just a tad expensive. The orange line represents an estimate of its fair value or intrinsic value, and the blue line represents how the market has tended to value the company over time. So the further the latest black stock price point is under both the orange and blue lines, that means the cheaper it probably is. If it's on or near the lines, then it's probably fairly priced, and if the black line is way over the other two lines, then it means it's probably expensive. Of course, you should never blindly buy or sell based on one simple FASTgraphs, and remember this data isn't something you should take as gospel or as precise, just something that is probably indicative. And you always want to understand more about a company before you invest, including trying to understand why its price is where it's at, what sort of financial trends it has, what sort of future growth expectations there are, how the company is positioning itself in its industry, etc. Speaking of future growth expectations, let's switch to the forecasting tool, which attempts to estimate how a ticker might grow over time. So again, we see that right now AbbVie appears to be fairly valued, not cheap, since it's right on the orange line. Personally, I'm okay to DCA into something when it's reasonably priced or inexpensive, assuming it's something I want, but I don't do large lump sum investments when something is expensive. Anyway, this tool helps show you why sometimes even something that is at an all-time high might still be inexpensive, at least based on its earnings, as well as why something at an all-time low might not be cheap. Over time, I came to realize that stock prices often follow earnings, so if earnings keep increasing, then prices get pulled up too, though if prices get too far ahead of earnings, then they eventually tend to revert back. On the right, we see that FASTgraphs is showing an estimated growth rate of 7.36%, which is decent. We also see a current dividend yield of 3.65%. Near the bottom, we see a white line on the chart, which represents its payout ratio, and I can visually tell that it's about halfway up from the bottom of the screen towards the orange line, which means it's about at a 50% payout ratio, or if it's 75% of the way up, then it's a 75% payout ratio. You can also hover over the chart to get pop-ups telling you key information at that time, like its dividend yield and payout ratio and stuff like that. Another useful tool I like to use is part of what they call their fun graphs, and specifically let's look at AbbVie's income statement and then I'll select the dividends per share graph to visually see what their dividend history looks like. Now I know that AbbVie was spun off from Abbott Labs around 12 years ago, which is why we see 12 years of dividend payments here, and AbbVie's an aristocrat because it inherited Abbott's dividend track record as defined by S&P Global, who formally defines the aristocrat methodology we all use. Here we can visually see that AbbVie's dividend was rising a bit faster in the early years, but lately its dividend CAGR has slowed down a bit. Let's just look at the last 5 years of dividend data for AbbVie. This tells us that AbbVie's 5-year dividend CAGR has been a good 8.69%. It's helpful to select different timeframes when you use FASTgraphs because then you get insights into how various trends are changing. Now before we move on, let's quickly look at Abbott to confirm that its dividend payouts over time show a dip when they spun off AbbVie. Sure enough, we can see that Abbott's dividends per share dipped as AbbVie spun off, and then it continued increasing again. If we navigate to Abbott's forecasting calculator, we see this, which quickly tells me that Abbott is looking expensive right now, and that its payout ratio is decent at around 40% to 50%, and I can see it's at a 2.13% dividend yield, and has a great 9.36% growth estimate. If we look at Abbott's 5-year dividend CAGR, we see an awesome 12.39%. Nice. Okay, with that behind us, let's review some cheap aristocrats. And remember that if something is cheap, that there are reasons for that being the case. Like maybe their estimated growth rates look bad, or maybe they're involved in some risky lawsuits, or maybe their industry isn't flourishing, or whatever. And also remember that an expensive price doesn't automatically mean you should sell, nor does a low price automatically mean you should buy. Okay, the first cheap dividend aristocrat of the 7 I found is Archer-Daniels-Midland, ticker ADM, a company that procures and processes agricultural products around the world. This forecasting graph indicates that ADM looks quite cheap, which can be enticing, but you should also immediately wonder why it's cheap. One reason might be this estimated growth rate, which is at negative 3.74%. Ouch. Let's take a look at their historical graph to see if anything jumps out. What we see is that years ago, ADM's stock price was trending okay, but then early this year the stock price plummeted. Looking into it, I found out that apparently an accounting scandal rocked the stock, and that led to them suspending their CFO. So it kind of makes sense to see the stock price get nailed if something shady is going on or perceived to be going on. In my experience, when stuff like that comes out on a stock, it can sometimes be hard to truly recover from it. But with more risk can come more reward. Of course, I'm usually too conservative to invest in cases like this, but you gotta decide what makes sense for you after you research it a lot more. Okay, and then looking at its last 5 years of dividend payments, we see a decent CAGR of 6.08%. Moving on, the next cheap dividend aristocrat I found is a financial stock called Franklin Resources, ticker BEN. Franklin provides financial services to individuals, institutions, pension plans, etc. You can see that BEN looks quite inexpensive. We see that it has a big 5.54% dividend yield, a very nice 10.96% estimated growth rate, and we see it has a nice payout ratio at about 50%. If we look at its last 5 years of dividend hikes, we can see an okay 5.46% dividend CAGR, though it looks to be slowing down like many companies these days. Franklin has been acquiring companies to help drive up their assets under management, but I'm concerned that they may be getting out over their skis. Of course, if they can smoothly integrate and capitalize on their acquisitions, then maybe they can finally turn the ship and stock price around, as they're about at the same price now that they were at 2 decades ago. Ouch. Moving on, next up is Chevron, which I'm long in, and you can tell it's looking decently underpriced. Chevron has an okay 4.25% yield, a relatively low 5.83% estimated growth rate, and about a 50% payout ratio. I feel it's okay to invest in oil if you need income for the short or medium terms, but I personally wouldn't be looking for solid extended growth as compared to other things you might invest in. Plus, you've got to deal with the crazy volatility that oil can bring, where frequent world events can shake up prices. But if you're patient, then you can be rewarded. If we look at its last 5 years of dividend hikes, we see a decent 6.16% CAGR, though one obvious risk is how renewables and other energy sources are becoming a larger part of our consumption patterns. Yes, I think oil will still be used in the next decade, but it's not something I want my kids to invest in. And since we're talking about oil stocks, another inexpensive aristocrat energy stock I own is ExxonMobil. Exxon has a somewhat low 3.47% yield, a low 4.5% estimated growth rate, and has about a 40 to 50% payout ratio. When we look at its dividends over time, we see a quite low 2.64% dividend CAGR, ick. Chevron looks a bit more compelling to me than Exxon these days, but they're both in the same ballpark of things. Okay, the next cheap dividend aristocrat I'll show you is Nucor Corporation, ticker NUE. Nucor is a materials company focusing on the manufacturing and sale of steel and steel products. It's got kinda a funky looking forecasting graph, which shows it had much higher earnings than the last couple years, so let's see what the historical graph looks like. Sure enough, it looks like they had a couple big years, and then things corrected back to the previous earnings trend line. If I was going to invest, I'd definitely dig into understanding what all the volatility was, but let's jump back into the forecasting graph. We see that Nucor has a very low 1.39% yield, a crappy negative 8.35% growth rate, and a low 15-ish% payout ratio. My guess is that Nucor probably missed their guidance and then lowered guidance even further, making things look ugly. I googled them and found this article from 2 months ago that said that they had an earnings miss and then analysts revised their forecasted growth targets down. Compared to the same period last year, Nucor's net earnings attributable to stockholders decreased from $1.14 billion, or $4.45 per diluted share, to $845 million, or $3.46 per diluted share. Revenue saw a 7% year-over-year decline, and apparently their performance reflected the challenges faced in the steel market as conditions cooled from the post-pandemic highs. Their CEO acknowledged the tough market conditions, but highlighted the company's strategic moves that they hope will put them on a better path. When I look at the last 5 years of dividend hikes, I see a decent 6.09% dividend CAGR. Okay, moving on. The second to last cheap dividend aristocrat in my list is one I'm long in and I'm currently investing a bit of its drip into, and that's Realty Income. One of the cool things about FASTgraphs is that it's smart enough to automatically adjust from earnings to AFFO, and thus this view shows us that Realty Income looks cheap today. Obviously, the interest rate concerns have pushed O down, as some people are worried about how much debt it has as well as the type of its debt, and some have concerns about O's tenants and their ability to prosper and pay rent. Those are all valid risks, but I'm still opting to slowly increase my position as I'm betting that their management team will successfully navigate these trying times and will reward me down the road. We can see that O has a very nice 5.94% dividend yield, but a low 3.45% growth rate, and if we look at its 5-year dividend history, we see a low dividend CAGR of 3%. Lately, O has been limping along with its dividend hikes in order to more safely navigate this tough interest rate environment. Fortunately, the rates have come down a lot, and as interest rates get cut, then REITs like O should prosper more and more. But time will tell. Okay, the final cheap dividend aristocrat I found is James Smucker, ticker SJM, a consumer staples packaged foods company, and I actually have some Smucker's jam in my fridge right now, and I think we have some Smucker's ice cream toppings as well. My kids love that stuff. Smucker's has an okay 3.77% yield, a mediocre 5.24% estimated growth, and a 40 to 50-ish% payout ratio. When we look at its 5-year history of dividend increases, we see a mediocre 4.51% dividend CAGR. So what has driven Smucker's down to this inexpensive territory? Well, last year Smucker's announced that they were buying the famous Hostess brand for over $5 billion, which means they would own some of my favorite childhood treats like Twinkies and Ding Dongs and fruit pies. And what normally happens when a company does a big acquisition is that their acquiring company's stock price takes a hit, and today Smucker's is about where it was a decade ago. Plus, they've not been doing stellar lately, and the increased debt combined with the tough interest rate environment, along with not always hitting analyst expectations, all leads to a stock which is depressed. Moving on, now let's look at some expensive dividend aristocrats. For example, look at Church & Dwight. I like this historical view because it shows you how its stock price has tracked its earnings and how much of a premium the market has given the company. You can tell it's consistently traded above its intrinsic value, and the market has given it a premium as represented in this blue line, but you can tell today it's way above its norms. And sure, it's possible they have a bunch of amazing new products that are flying off the shelves, but I'm doubting they're the next Nvidia, and instead are most likely just having inflated market expectations pushing the stock to unreasonable levels. I'd wager it will migrate back closer to its blue trend line, but as you can see, sometimes prices can remain elevated for years. Okay, and another dividend aristocrat that looks quite expensive right now is Cintas, which rents out corporate uniforms and other garments, amongst other things. But man, look at how their stock price has shot up. I love how boring dividend companies can still do just fine these days. And that reminds me of this comment I recently got on one of my videos, where the person was saying that he isn't a fan of dividend investing because inflation is too high and it eats up dividends. I responded that dividends in the US have outpaced inflation, on average, when looking over long periods of time. He then responded that from his experience, if you're young, that you want to stick to higher risk, higher return options. So I appreciated that he was sharing his perspective in a non-combative way, and the essence of what he was talking about makes sense, which is that young people can afford to take more risks with their investing. That being said, I'm also here to say that young people can also do great, and potentially even better, if they just invest in quote-unquote safe stuff like the index and nothing else. They don't need to take on extra risk by going after long-shot investments. I've seen how boring and slow and steady has done well over the long run, and there isn't a need to go with riskier things. Steady Eddie blue chip stocks will probably do everyone just fine over the long run. Sure, I don't mind putting a few percent into super risky things like crypto or some IPO or whatever, but I don't think you've got to do that if you don't want to. Okay, let's quickly look at 2 more expensive dividend aristocrats. The first is W.W. Grainger, an industrial company that does stuff like pumps, plumbing and storage equipment, tools, etc. You can see its stock is looking expensive relative to its earnings and trends. And then the last expensive dividend aristocrat is Nordson, an industrial company involved with adhesive, lotions, sealants, and tons of other things. It has a nice slope of earnings trending up over time like you want to see, but it's still looking like it's running hot. Note there are a ton of other dividend aristocrats that are expensive, but I just wanted to give you a sampling of things. And with that, I'd like to close things off and recommend that you consider using my FASTgraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off the first payment even if they sign up for a full year. I'll also recommend checking out my Seeking Alpha affiliate link, as new users often get discounts for signing up. Finally, take a look at my Patreon to see if there's any seats you want to sign up for, but since my Patreon Aristocrat and King seats are usually sold out, I'll also recommend that you join my channel membership, which gives you a variety of perks, including a badge icon that is placed by your comments on my videos and which levels up over time as long as you're a member, and you get the ability to vote on which thumbnails I use for my next video, and you get to watch my videos about a day before I release them publicly. But whatever you do, please first hit that thumbs up button, subscribe if you haven't yet, and click the bell notification. And don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 81 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.